Well, hello everyone. Thank you for joining us for today's training. We're going to be going over ACA, marketing, compliance, and enrollment. Today is July 11th, 2024. We would have had this in office, but due to technical difficulties, we have had to do this virtually, and we will be submitting this out next week, so it'll be a couple of days old by the time you get to it, but that's okay. I'm Nolan Ebbinghaus. I am the Agent Success Manager for Hovis & Associates, and I'm joined today with Jason Muehlhausler, President of Mule Group.
Hi, everyone. We got some good stuff to go for you for today, but there is some dry information. We're going to try to make this as interesting as possible. A lot of good stuff, and we're glad to have you with us.
And today's meeting is sponsored by Medica IFP. Thank you so much for participating with us as a valued partner. So let's just go over the meeting agenda for today. We're going to be handling a few different pieces here under marketing. Why sell ACA? Why even get into this portion of the insurance world? Who would typically be the clients that you're looking to help or prospects you're looking to help? We're going to touch a little bit on Facebook ad library, and then beyond that, we're going to be teasing out a training that we're going to be more in depth in the future here about Facebook marketing and how to really leverage that to expand your book of business in ACA. Beyond that, we're going to hit compliance points, obtaining valid consent, enrollment periods, and the TCPA overview. Now, keep in mind, some of this is a little bit in flux with the recent Chevron doctrine having been thrown out. So this is as far as it goes today, what these are looking like they're going to be in the near future. Then after that, we're going to touch a little bit on ICRA and QSARA, as we believe that's a great avenue for the future of ACA business and the like. And then beyond that, on our fourth portion of this presentation, we'll be going and doing a little bit of a deep dive into the APTCs. And if you don't know what that acronym stands for, you will soon know at the end of this presentation. We have a short video from Health Sherpa about enrollment and how to do that on their platform. And then we're going to talk a little bit about the plan offering from Medica in the Missouri area. So with that being said, without further ado, we'll go ahead and jump in here. The question really comes up as to why should someone begin to sell ACA plans? And, there's a few reasons on this screen here, but we'll go ahead and highlight a few. Commissions are paid per member per month up to a family of 5. So yes, if you have the Partridge family that you're enrolling, you're only going to be able to get 5 of those people as far as commissionability is concerned. But that is really solid. And Jason, correct me if I'm wrong, but we're looking, around $20 per member per month?
Yep. In Missouri, it's $20 per member per month for the majority of I think all carriers really at this point. But yes, correct.
Now, of course, all of this is a little bit dependent on the carriers. And as we know in insurance, things can change rapidly, but this is kind of where we are today. Beyond that, this is a great opportunity for new business and also retention. We know so many times people have maybe a younger spouse who doesn't quite qualify for Medicare, and guess what? If the older spouse wants to retire and stop working and get off their group health plan, that leaves their spouse who might be on that group health plan, without options. So as opposed to referring that business out, you can go ahead and write that business, and then that person will definitely be someone that you'll be able to convert over to Medicare once they hit Medicare eligibility. Minimal chargebacks, we're really not going to be hurt by clawbacks quite as devastatingly as you would in the Medicare space. And then, also, we have reputable carriers that we're presenting here, so it's not fly-by-night insurance carriers. And Jason, did you have anything you wanted to add before we get to the next one?
Yeah, on the minimal chargebacks, that's actually a pretty nice thing because it's all paid as earned. So you won't have, even if you have a rapid disenrollment, you're not getting that chargeback for a new client like you would on Medicare. That obviously makes it a lot easier if you have a downline or even for yourself to not worry about getting charged back. I personally like the as earned model with the ACA and not having to worry about that as much.
And I'm sure at this moment we're all feeling the weight of all of the certifications we need to take on for our Medicare, and with ACA carriers there really isn't a requirement to do a yearly certification. And
yeah, let me interject on that because I know everyone's getting their AHIP done, and as everyone's seen on Section 4, they have a timer now to even get through the slides. Well, On the ACA stuff, for a returning agent to get their FFM certification, it takes like 45 minutes, and then you don't have to do all the individual classes per carrier. So it's much easier to continue to be up and running and selling the ACA and getting paid on it. And it's not as much of a hassle, which is huge.
Love it. And this actually came over from the folks from Medica, so we appreciate them sharing some of this information with us. But it looks like 5 million more consumers selected a marketplace plan in 24 than they did in 23, which is a 31.2% increase, which is massive. And in Missouri alone, we had an additional 359,000 consumers select a plan, which is almost a 40% increase. And we're, on a national average, consumers save more than $800 per year on premiums.
And I think another thing to add too is, we're still in the midst of the Medicaid unwinding scenario. So you have a lot of people that are coming off of Medicaid that don't have insurance and don't know what to do. And they are perfect candidates for a 93% CSR, which we'll get more into, and getting a free plan from the Affordable Care Act when they really don't have any other options. So those numbers are going to continue to increase.
I agree. So who are ACA clients? We've got a couple examples here. John and Melissa, they're self-employed entrepreneurs. They continue to expand their family, and they may qualify for subsidies. Pam, she just turned 61 years old, and she's not, and she recently retired, but she's not eligible for Medicare yet. So what is she to do in that position? Then you have the lovely Sarah. She's a single female who works for a small company that does not offer benefits or insurance. And then lastly, you've got Michael. He's a 27-year-old who no longer is on his parents' insurance, and he's now a grad student working part-time, and he could qualify for subsidies depending on his income. I don't think grad students make a lot of money, but I could be wrong about that. Now, also keep in mind that these are all QHPs, qualified health plans. So they meet minimal standards required by the Affordable Care Act. And I've heard people refer to these plans as Cadillac, Lamborghini coverage because there is no ceiling to the amount that they will cover. Unlike some of the short-term medical plans that we know recently have had some legislative pen strokes that have limited those enrollments. So if you have been selling short-term care policies, now would be a good time to really investigate these ACA plans, as those will be or have been really severely limited. Another thing is that they all require these 10 essential health benefits. I'll let everybody go ahead and read those by themselves, but suffice to say that core medical benefits are strong with these plans, and there probably won't be coverage for cosmetic type of things. So obviously, it would have a necessity to require that coverage, but.
Well, and it's good to know, too, so when you have an employer over 50, when they're considered credible coverage, it's because they're offering these 10 essential health benefits. So when you're looking at a short-term medical policy or a COBRA plan, they're usually missing, maybe not all, but at least one of these where they're not actually considered credible coverage. So that's where that comes from, if you ever hear that terminology. And then I'm going to kind of do the Facebook teaser on some of the things we're doing with marketing. So just a little bit about myself. We have 4,500 lives insured through the Affordable Care Act, and the majority, I'd say about 80% of it is through our Facebook marketing efforts.
Wow.
So, we're going to kind of touch on this in this learning, but then we're going to have a specified class for that because it's also very useful in the Medicare space as well if you're doing it the right way. But there's some interesting things you can do to actually find out what your competition is doing in that space as well. We're going to kind of touch into this here. One thing to note is that when we show you how to kind of look at what the market's doing through the Facebook ads, just because there's an ad on there doesn't mean it's compliant. So you still have to know kind of the rules and everything. And as we all know, there's rogue agents everywhere. So if you see an ad that's, very successful, and okay, this is not compliant, well, by all means, do not copy or use any of those ideas, right? But through the media library through Facebook, you're actually able to see what ads are running. You can see how many impressions those ads have gotten, and you can see the amount spent. Now, how can we use that for our own knowledge? Well, if you have an ad that's on there that's been up for 6 months with thousands of impressions, well, whoever has that ad out there is obviously getting a return on it, or they would have turned that off within the first 2 months. So let's kind of dive into what that platform looks like.
Quick note that URL was at the top of the last slide. So, and we will be sending this slide deck out to everybody. So if you miss something or if there's a clickable link that we want you to follow, just know that we will be sending this out to everybody.
Yep. So this is what, when you put in that URL for the Facebook ads library, this is what the front page is going to look like. And what you do is where this says choose ad category here in the middle, that little magnifying glass, you would actually type in whatever ad you're looking for. So to give you an idea, if you're looking for, ACA plans, type in $0 health insurance or health insurance for under 65. And what it's going to do, it's going to pull up a list of ads that it's tied to those search terms. A couple of Medicare ones could be, AEP, obviously during AEP, Medicare ads, and then specific carriers for our area. You can look up Essence, Medicare Advantage, and it would pull up all the Essence ads. Obviously, there's not going to be many now, but when AEP runs across, we'll have, those will start showing up a lot more. And this is what it's going to look like. So these are actual ads that no one had ran a search for. You can see up top, he uses the search term ACA for Affordable Care Act. And these are some of the plans that showed up. So as you can see, Obamacare, $0 a month plans, and these are actually all compliant. So the nice thing about the Affordable Care Act is that it's not like Medicare. You can actually walk into a Walmart and say you're offering $0 health insurance and be compliant on the Affordable Care Act side. Now, where you'll see agents getting themselves in trouble is when they're lying about benefits. So some of the ones that have been out lately is that people are saying get $1,600 a year in subsidies for food. Well, that, as you all know, that subsidy goes to paying down the premiums if they're low income. So that's completely non-compliant, and those agents will eventually get taken care of. But that goes back to what me and Nolan were saying, that just because it's on here and you're doing your competitive research does not mean it's always compliant. So you have to do your due diligence and think about what these people are putting out there. But as you can see, you can kind of see exactly what everyone's on there doing. And if you look at this particular ad, say this ACA health insurance $0 a month premium, if you look under up the top of it, it says active. So you know that's running, and you know it's been running since June 14th. Well, Facebook ads aren't traditionally cheap. To get any kind of worth return, you're going to have to spend, $500 to $1,000 a month on it. So if they've had that running for at least a month, and it's the 11th now, it's getting some kind of results. Because if they were getting no results, then they would have shut that down within a couple of weeks. Now I'm limited on what I can scroll down to on this page, but there will be ads that have been on there for 4 or 5 months. Now those are even stronger than these, because those have been tested basically and been able to overcome the ROI for their ads. So those would definitely be ones that you can, and one thing, never copy them word for word, but use them for your own ideas and come up with something better. Use your own, pictures and all that stuff, but a good way to see kind of what the market's doing out there. Yeah, and here's some more, as you can see. Actually, so you see Family Obamacare, enroll now, $0 a month. I personally would recommend never using the word Obamacare, just because whether you're on the left or right, it's got negative stipulations per certain people. So you always use Affordable Care Act, to be honest with you, because a lot of people don't realize that it ties into Obamacare.
Or maybe even use both and see how they work. In certain markets, maybe the Obamacare moniker might actually be a little bit better or not. But I do believe that it is a little bit more of a lightning rod politically. So yeah, using ACA would be a little bit better, I would think as well. And of course,
not really. Maybe. It's classified.
Of course, you're going to get some pieces in there that aren't anything to do with what you're looking at. ACA Las Tortas is not going to be something you're going to look for your
right
for your marketing.
Yeah, but that's just a little teaser. So we're going to have a standalone class on Facebook, because there's some more things that go into it, like tying in a pixel so that Facebook can track results and everything if you're sending it off page, and how Facebook optimizes it, and how to set target audiences and stuff to get more of an ROI on your return from those ads. But that's going to be that's something that you can use in any business you ever do, whether it's Medicare, ACA, ancillary products. It's just going to be so useful in many avenues.
Yeah, so be on the lookout for contracted agents. We're going to be doing some deep dives. As Jason pointed out, over 4,500 lives in ACA, and 80% of which were derived from Facebook marketing. We already talked a little bit about the commission per member per month, so you can do the math. And so, we're going to talk a little bit more about some of these different avenues, but really you're going to want to keep an eye out for that in-depth training that we will launch, hopefully as soon as we can. Obviously, we're all drinking from a fire hose right now, but we'll be launching that as soon as possible. But you see a couple of different examples up here of areas in which people could get creative with their marketing. Every time I go to the grocery store, I think about this, and I'd like to go ahead and share this video. So have you ever seen those pieces of ads that show up on the back of your receipt? Well, this is that company. So enjoy the video here.
Indoor Media started in 1989 as a small, humble company, then organically grew into an international media company by helping businesses grow using our advertising. We currently network with over 9,400 grocery stores in the US and Canada. We place your full-color ad on a receipt into your potential customers' hands to make people who don't know about you, have never visited you, or worse, are going to your competitor, want to come to your business. To make sure you never miss your potential customer, we hand out your ad thousands of times per day, every single day, all day long. We capture all sorts of people, yet about 70% are women age 35 and above who see your ad. So if you're looking for more families, then this is the right media for you. We're able to hand deliver 1,000 of your full color ads for only $5 to $9. And over the last few years, we've gathered over 20,000 customers' data, which will show the return on their investment and which ads work best. Let us spend a few minutes going over your area, the grocery stores available, and all of the business data to see if this is the right fit for you.
So I think that there are plenty of ways. Obviously, marketing works, or else people wouldn't be marketing, and that is just one piece that I think is kind of interesting. I also threw up this next door business, ad manager. There are definitely mixed results and reviews for next door, and I would just say that maybe as opposed to launching, content that's boosted, or ad content that's boosted, that you just actually engage in this platform. The amount of engagement I see for somebody having left a couch out on the side of the road is incredible. So if you can post some real content, then that can drive a lot of clicks and a lot of engagement for you on Nextdoor. Have you ever done anything with Nextdoor?
I personally haven't done any ads on Nextdoor, but I will tell you I'm in some neighborhood groups over in my area in Catawissa, which is Franklin County, and you'll have people all the time. Hey, who knows a good handyman? Who knows a good So you'd be surprised how fast you can pull into some referrals and leads that way just by being active in your communities. So yeah, definitely something to look at.
Another one, actually, this was really interesting because I noticed I was actually going to as the Brits call it the loo, and I saw these digital ad boards, and so I reached out, and really the way it looks like to me is that it's just another creative, interesting way to get your brand and to get your call to action in front of folks. And, you can look at some of those metrics here. I mean, they're saying basically about 7.5 seconds every 90 seconds. But since they're only 50% bought right now, you're going to run twice in a 90-second loop. And, you can see that they've got it in front of the water dispenser at the gym, right over the urinals in the bathroom here. And then over here, it's kind of by the vanity for the ladies. So really kind of interesting and not overly expensive, $20 to $30 per billboard per month, which is these digital billboards. So really kind of another avenue to kind of look at. And then if you want to talk a little bit about lead concepts.
Yeah, so I've done lead concept direct mailers for several years now since I started my brokerage on the Medicare side. And they've by far, out of all the lead companies I've used, and it's probably 8 or 9 at this point, they're the most consistent. So they send out a direct mailer, and then they are, for turning 65s, and they are actually returning a mailer back to Lead Concepts. And what Lead Concepts do is they put them into a CRM, which you can link to whatever systems you're using, but then you have that permission to contact after they've said they're interested. So a very good way to build up marketing efforts there for direct mailers for a company that's been around for 30 years, and actually does a pretty darn good job.
So yeah, keep this in mind. We're talking about ACA today, but a lot of these things can be used in the Medicare space as well, and this would be great for actually boosting up maybe some seminar attendance.
And when we talk to that, so we know this year, this AEP with all the changes with the Inflation Reduction Act, that 70% of Medicare recipients are going to be shoppers this year versus 13-15%. That's the norm. So seminars are going to be another great avenue to get in front of people. And I had Lead Concepts quote me out what a monthly seminar would look like. And for about 1,000 mailers, which they're saying you'll get about 20 to 40 people in a seminar, and then they have an internal team actually called to do the RSVPs to make sure people are going to show up. It comes out to around $1,650 per seminar. And what you basically would do is if you want to do it at a restaurant, obviously follow all the CMS compliance rules and everything for the meetings, or like a library or a free venue, whatever you can find. But a great way to get in front of more people, especially when it's going to be even more pertinent this year than most.
Huge plan year for the Medicare stuff. So let's see, what else we got? All right, so B&I, you could talk to us a little bit about your B&I experience. I thought it was kind of fascinating what you had said. You kind of resulted with the last couple of meetings you had.
Yeah, so on the, and this is back to the Affordable Care Act. So the B&Is are great avenues for referrals for the Affordable Care Act. So I joined one that I've been in for about 4 weeks now on the Affordable Care Act stuff. And I kid you not, I'm probably up to about 60 to 70 ACA referrals just from the B&I group. Because what you can do, you'll run into a lot of small businesses that, have maybe 15 to 30 employees. Well, they're not in the position where they can offer true group insurance. And it's like you can connect that dot between health insurance and their employees that are hourly coming in there. Most of the time, give them a free plan. And it's not provided by the company, but it's all optics. You can make it look like, that company's helped them get insurance, which they are because they're connecting you with them. But just a great avenue for easy referrals by joining those groups. And then also, like in those groups are usually going to have a doctor will take up the medical seat. They'll have, a financial advisor, which will take up the, financial aspect seat. But those are great referral partners. Obviously, as you know, the doctors for Medicare and Affordable Care Act stuff. But the financial advisors, I've talked to probably 16 or 20 of them at this point, that they don't get a lot of Medicare questions. But you know what questions they do get consistently? I'm retiring early. Why is COBRA so expensive? Well, guess what? The Affordable Care Act is a perfect transition from when they retire early, usually the cheapest with the best coverage, to the point they go into Medicare, which then you bridge that gap to Medicare and you become their Medicare broker as well. So B&I groups are untapped resource. If you haven't been doing any kind of networking groups, I'd highly recommend it as well.
And I put the grass down there because, hey, listen, as far as dollars for marketing concerned, sometimes, you don't really may not have, substantial budget for marketing. And so, if you're not going to spend dollars, at least you could spend time. So we definitely think this is a great avenue. And there are plenty of other marketing groups, networking groups rather, out there. Tips would be one as well. Some of them have an entry fee or a yearly fee, but really what it comes down to is it is what you make of it.
Do you want to form an alliance with me?
Absolutely, I do.
Good, excellent. Okay.
Now, I will also throw out there, I don't have a slide on it, but Integrity's Medicare Center platform actually will, in Lead Center, you can actually purchase ACA leads. I haven't actually been able to exercise that option as of yet to kind of tell what the what would you call that, conversion rate would be, but it's definitely another avenue to look into. Now, all right, so we're going to get into the real fun stuff here, which is the marketplace compliance. Now, keep in mind that this is really intended for federally facilitated marketplace states, and the state-based marketplaces have some of their own requirements. And of course, every state has certain rules they can layer on top of whatever they have. But this is just a general outline of some things to keep in mind when it comes down to compliance with these marketplace plans. Keep in mind, right now it looks like in the ACA space that compliance does not have as many hoops as Medicare does, and that's fantastic. That means it's a little bit lower of a barrier to entry to actually get in and start writing some of these policies without having to worry about stepping on any trap doors or any bear traps. But one of the things Jason and I have discussed is, hey, listen, if you pursue ACA with the same level of compliance acumen and standard as the ACA marketplace becomes more heavily regulated, which I think is a fair guess to say that it will probably go that direction, well, you're already ahead of the curve.
Treat it like your Medicare book of business, because those rules are eventually going to come into place for the Affordable Care Act, I would imagine, down the line. It's starting to go that way now. But if you just use the same processes you're using for Medicare, as far as getting, permission to contact, basically the sheet saying that they're giving you permission to be their broker, and the permission on the plan they select and all that stuff, which we'll go into, you'll be fine. It served me well that I went in there with that mentality, doing kind of the same things that we are held to as a standard for Medicare with the Affordable Care Act. You'll be far ahead of the game. You'll never have to worry about compliance, to be honest with you. Yeah.
So first things first, you have to be certified to sell the plans. So I've talked to many brokers who maybe started with ACA when it first kind of opened up to the broker channel distribution, and they have returned and they're not showing up as returning agents and brokers. So I'd say probably if you haven't looked at it within 5 to plus years, you're going to show up as a new agent and broker for policy year 2025. Now, these documents were for 24, but I don't think they've changed much in the past couple of years, so that's why I put it as 25. We'll send this out in an email. It's basically the job aid so that you can access these systems. But you're creating an account on the CMS Enterprise portal. You're requesting the agent broker role. That can be kind of confusing for folks. You're not going to be a web broker or an assister. You're going to be an agent broker. You complete the identity proofing. How long do you say that usually takes?
I think we talked about this morning. It can be a couple hours to a couple of days, but they're usually pretty fast on it. But the thing to know is that this form that Nolan will send out, it does take you step by step. So it's pretty straightforward, and as long as you follow the steps, you shouldn't have any issues getting your FFM certification to be able to sell the Affordable Care Act stuff.
Now, unfortunately, at the time of this recording, today is the last day that the FFM, the MLMS training portal for CMS is open. They're going to be actually blacking it out on July the 12th, and it should reopen again either mid to late August. And that's just them basically changing over everything from plan year 24 to plan year 25. So, go ahead and focus on those Medicare certifications, those carrier certifications, and then once it opens back up again, we will send out a reminder to folks that they can now re-engage with their CMS Enterprise portal to get that training completed. If you have already completed your training, we recommend, or whenever you do complete your training, we recommend going ahead and print your certificate. It's a good thing to have. Always pull down a PDF of your certificates for any carrier or any certification you have, just to have that in case it's requested for anything in the future. The returning agents and brokers, it's a little bit of a different process, but we just know that you're going to go through all the training slides and answer, about 10 questions at the end, and then this is going to be more of like a refresher or anything that's kind of changed, that's new, that you should be made aware of. So that's that. Now, the other thing is, not unlike a scope of appointment or permission to contact, this is the ACA's version of what that is. So obtaining ballot consent is very important. There has been a lot of going back and forth about what the issue of the day is, which would be AOR switching. Carriers have made some movements to kind of abate that issue. CMS is looking at it with really close, with a microscope, trying to honestly deal with that. And I will say that the offending agents and agencies are losing their licenses, being held civilly accountable. There's a lot of stuff coming down. So here at Hovis and Associates and also with Mule Group, we don't play that game. We only want to enroll people who are aware that they're enrolling in a plan that we've discussed with them.
Yeah, and to give you some background, so you'd have, we kind of talked about a little bit up front with the Facebook marketing. You'd have some agencies that are promising benefits that do not exist, which obviously is a no-no. And then you would actually have some of these call centers. What they're doing is they're buying data lists and just searching by people's names and birthdays and then switching them under their AOR without ever talking to them. So obviously those, in due time, it always comes back around. They will be losing their license and everything, but that's why it's important to, again, treat this kind of like your Medicare book, where you're getting all your compliance stuff is taken care of and you're getting the right documents and everything up front.
Agents and brokers should only make updates to a consumer's application or policy at the direction of the consumer or their authorized representative, and this includes, but it's not limited to, conducting a search for the consumer's application using an approved classic direct enrollment or enhanced direct enrollment website, helping consumers apply for financial help and or enroll in a marketplace qualified health plan, including checking the status of their coverage and making updates throughout the year, calling the marketplace call center to ask about the status of a marketplace enrollment or to make consumer application changes. Now, one of the interesting things here is that CMS has their model consent form, the operative word being their model consent form, which we will show here in a second. But here are some consent document requirements. And what's implied here is that you can put your brand on the page as long as it actually covers everything that it shows here. Then you can make it your own to a certain extent, but you just want to make sure that you're actually hitting all the key points that they have. So a description of the scope, purpose, and duration of consent provided by the consumer or their authorized representative, the date the consent was given, the name of the consumer and or their authorized representative, the name of the agent, broker, or web broker or agency being granted consent, a process through which the consumer or authorized representative may rescind the consent, and the agent, broker, or web broker must obtain these documents. We've seen that before, 10 years.
Yeah, and make sure it's getting a wet signature as well on that document.
So this is a picture of pretty much what the model consent form is. I mean, this is something we can send out. It's easily accessible through CMS. You can Google search it, but we'll be sending this out as well. But we do have at Hovis & Associates, we've created an intake form as well. But, this is another opportunity to get your brand out there and to show that you are, really a professional outfit, so you can put your own branding and whatnot there and make it available to folks.
And there will be, if anyone's using the Retire Flow that Hovis has kind of, well, there it is. Perfect. Yeah, so RetireFlow is going to have their own ACA consent form as well, which that's a pretty slick platform for obtaining not only the Medicare side of things, but the ACA as well.
Now, they are launching this ACA, basically the consent form, the client information, all that good stuff. There are going to be some webinars coming up, one on July the 18th, one on August the 1st. Your Hovis 40 promo code, all caps, HOVIS 40 will also work for the discount for this program. I think that brings it down from $50 to $30 respectively.
And I don't know if you touched on these in the slides, but the Retire Flow, they are coming out with some direct API connections to Connecture and stuff, which I think Medicare Center is involved in that. So there will be, and I don't know exactly when that's coming out, but there will be a time where there's going to be less double entry, that when they fill out their doctors and prescriptions through the Retire Flow, that it will actually update your Medicare Center. And I think that's actually that. I think they were planning on having that before AEP, but that's in the works. I know that.
Yeah, we'll see how as far as the API with Connecture under Medicare Center. I think there's still a few more hands that have to shake on that one, but I wouldn't be surprised if it is included relatively soon. Mm-hmm. So beyond that, I'll let everybody kind of look at these screens. We really would prefer to be over exhaustive than under informing, and these are pretty much boilerplate, simple. If you see suspicious activity, you've got a client who's having some issues with maybe AOR changing, you can email So some do's and don'ts here. I'll let this screen speak for itself. Basically you just want to make sure that you have valid consent, that you are reporting fraudulent activity, and then beyond that, that you're ensuring that you have as much of the correct documents, information on the documents as possible, to the best of the knowledge of the person you're speaking with, and that includes, of course, social security numbers and all that good stuff, and that you are making timely updates to the personal contact information for your own information in NIPR, because the platform Health Sherpa will require to ping NIPR regularly. I think they've changed that interval to every 12 hours. But basically, whenever you log on to Health Sherpa, you're going to ping NIPR, and it's going to check to make sure that everything is still valid, active, and up to date. Some don'ts, of course, you shouldn't retain access to the consumershealthcare.gov account or associated email. Now, using an enhanced direct enrollment platform like Health Sherpa kind of abates some of that issue, but suffice to say that you should not also use any false or dummy addresses for a consumer's email, and it would be just more compliant and more helpful if you help them set up their own email than it would be for you to go ahead and take the shortcut and have it all sent to your email.
Yeah, we'll probably have another standalone class on Health Sherpa, but it's actually better to have their correct information. Well, I know that goes without saying, but having the right email in there, they'll actually get notifications from healthcare.gov. So like if they need to do an income verification or have any requirements that haven't been met yet, well, it will auto send those and ping them for that information without you having to be involved most of the time. And a lot of times they're getting that done. Just makes your job a little bit easier by having the correct information in there as well.
Now, we all know that protecting private identifiable information is key. You could think about it and be very logical. Really what it comes down to is making sure that, for instance, you're not sending or forwarding emails that are not encrypted, that if there are documents that you need to give back to the client, if you have an in-person appointment, that you're giving them a manila folder. I mean, you just use your common sense when it comes down to protecting PII, because it is critical, especially as far as today is concerned, where it seems like people's information and data are constantly being breached. Some enrollment periods to speak of. If you're familiar with OEP in Medicare, this is not the same thing. This is ACA's OEP, which is better than calling it AEP and having two AEPs at the same time of the year. So ACA's open enrollment period is from November the 1st to January 15th. Now, one little note here is that there are basically, it's like a stutter step. December 15th is the deadline to have a January 1st policy, and January 15th is the deadline to enroll for a February 1st policy.
And I will throw out that even though it goes to January 15th, if you have people that are actively enrolled under you, you do want to make sure you get them touched before the end of December, because that new plan will go into effect January 1st. So even though you have what seems to be an extra 15 days, it is best practices to get their stuff updated before the end of December.
And of course, you have year-round enrollment ability through special enrollment periods. Qualifying life events, we'll touch on some of that. That could open up an election period. So some of those election periods or qualifying life events that would open up a special election period would be getting married, having or adopting a child, becoming a U.S. citizen, congratulations, divorce or legal separation, gaining or losing dependent, involuntary loss of coverage, change in economic level, newly eligible for subsidy or loss of subsidy, leaving incarceration, loss of student health plan. We could go through the whole list, but it kind of speaks for itself. If there's a real material change in their lives, then it could potentially open them up for an SEP.
And there is one that's being utilized more than others. There's the low income SEP that it basically goes year round. So if they're under I think 150% federal poverty level, that they can enroll into an Affordable Care Act plan at any time for the first of the following month. So that's definitely a great option to market and get out into the communities for those people that need the help, that are low income, that do not have health insurance coverage. And trust me, there's still a lot of them out there where they can enroll at any time, basically.
And correct me if I'm wrong, but that's going to be probably between 100 and 150 because at 100% FBL or below, you're going to be potentially eligible for Medicaid.
Yeah, and that's another thing. But here's a good thing to know about Missouri Health Net. Even when people are seemingly, as you know, we dealt with one on the Medicare side, even when people are by the book eligible, well, MoHealth doesn't always accept them right away, or they don't respond to documentation, and a lot of things fall through on that. So I would still encourage you to, even when they're seemingly qualified for Medicaid and they put that application in, they can have an Affordable Care Act plan while that's being processed and bridge that gap as well.
Interesting.
Well, and that's actually a great point because, as a lot of you know, that if they're doing a Medicaid application, well, Missouri Health Net doesn't always backdate that to the date of the application. It's, I believe, up to the carrier, right? So in that, a lot of people, like I had a family who was going through that process, and they had a 4-year-old that for 3 months while they're waiting for that to be processed, they're like, what do we do? Do we pay these bills? And Mo Health Net specifically said to them, yeah, you better pay them because we can't guarantee you're going to have backdated coverage. So that was when the Affordable Care Act was a perfect solution to bridge that gap. And all you do is when they get the Medicaid, they get a letter that says, we see that you have Affordable Care Act coverage. Just please terminate that policy within 30 days and you're good to go. So another great opportunity to bridge that gap and help someone out there.
Very good. Very good. Outbound communications and FTCA, like I mentioned earlier, the throwing out the Chevron doctrine is going to have impacts that we don't exactly know the full breadth of those impacts, and this could be one of the items that is impact in a regulatory sense. But this is some of the pieces we're discussing here. You know, when it comes down to the TCPA, it's the Telephone Consumer Protection Act. It's a way to basically safeguard the consumer's privacy, and it restricts telemarketing communications via voice calls, SMS, text messages, fax. The FTCA, the Federal Trade Commission Act, is basically prohibiting unfair and deceptive acts or practices in affecting commerce. So if you're out there lying to get prospects, well, this is something where you're likely going to be in violation. Consumer opt-out requests, we all know, and if you don't, you will know that, when you're sending out, let's say, a mass text message, you have a lot of leads that you're working with, and of course we're talking on the ACA side of things right now, but this is actually across all marketing here. You need to allow for an opt-out request on those communications, and you need to keep those in a log that you maintain for 10 years. That's why picking the right systems to work with and sticking with them, or making sure that if you do change systems, that the information you send over to the new system is accurate and maintained, because you want to make sure you're not breaking these rules by reaching back out to somebody who has opted out of communications. I thought this was kind of interesting as well. I never think that to myself that I would be calling leads after 9 p.m. on any given day, but there are rules around that, so I'm guessing somewhere along the line somebody was making lead calls after 9 p.m. So you can see here you're between 8 a.m. and 9 p.m. And in Missouri, actually, calling during the prohibited hours can cost you a fine of $1,000 per violation.
Which is kind of wild and kind of makes sense. Like I try not to make calls before 9:30, and definitely nothing ever after 7.
Don't call me. Don't come by my house. We're done.
Clock.
It's midnight. What are you calling me for? So outbound requirements for mass text messaging. I mentioned it earlier. Hey, you have to allow for there to be an unsubscribe, reply stop to unsubscribe. and you need to remove them or scrub them from your list if they do hit that unsubscribe. Okay. Examples of potentially deceptive practices under the FTCA: phrasing or appearance implying that mailers are from a government agency, such as adding unnecessary processing numbers or stating that an insurance product is state regulated. We've all seen documents. We've had clients who have called us with really official looking documents that look like they're coming from Social Security, coming from a government agency. That is a big no-no, and it will get you in big trouble. Phrasing or appearance of implying that mailers or from another company, such as a bank, it'd be one thing to have somebody's financial advisor to send out a letter suggesting you as a person to speak with about their benefits. That's perfectly fine, but trying to capture it through the authority of some institution they utilize is a no-no as well. And hey, if you're going to be promising rewards like a $5 Walmart gift card for certain things, which I don't believe you should really be offering gift cards for people to meet with you on ACA, but if you don't provide those rewards, well, you're going to be in trouble.
Which, interesting on that, just from an advertising perspective, like when you're giving out those rewards or stuff like that, those are usually lower intent possible potential clients anyway, so they're not going to be as good as a client that's actually interested in your services. So
they're in it for the free stuff.
Yeah.
Let's see. Failure to disclose that the contact information provided for obtainment of quote will be used to contact the user. They have to know what they're getting themselves into. You have to make it clear to them why they're putting their information down. And, I thought this one was kind of interesting when looking through these rules. This one is actually geared towards agent recruitment. Hey, how many times have you seen people recruiting agents saying that they're going to be multimillionaires within the first year? Not acceptable. Okay, you can't go out doing that.
Which is wild because I feel like everyone in that space does that still. So
I won't point any fingers, but it's really interesting. So yeah, you can look through these, on your own time whenever we send this out. Now this is a big one here, and I think that there are still some information coming out. Some of it needs to be clarified still as far as passing through potential prospect leads from an agency to a downline agency or internally as far as giving consent to contact. But one-to-one consent is exactly that. The person, if they're giving consent to be contacted, there is but one person who can contact them, and they need to know who it is and what it's about. So it prevents lead generators from obtaining consent on behalf of multiple businesses or sellers.
But I think that goes into why me and Nolan are going to create some of these classes on, maybe the Facebook marketing or how to do your own direct mailers or whatever it may be. Because I think as this industry continues to evolve, that it's going to be even more and more important to have your own lead generation. Not only as an ROI perspective, but a compliance perspective, and just keeping all your data in-house for yourself and your agency.
Absolutely. I get a little nervous sometimes when I speak with brokers and they have some company running their Facebook ads for them, and they're paying a mint and not getting any return. And up to this point, I'd almost say that they probably are pocketing some of the money, putting some of the money on the ads, and then when the leads come through, they're selling those leads to somebody else. So, being able to run it yourself, and we're going to be happy to kind of walk people through that process so you become more dynamic. Marketing works, like I said, or else people wouldn't be doing it. So being able to market for yourself is going to be able to hit that requirement for one-to-one consent. We made it to this portion of the presentation where we're going to discuss ICRA and QSARA. Why ICRA? Okay, individual coverage health reimbursement arrangement. Well, you're going to be able to sell groups of people on ACA coverage while saving employers money on their second biggest budget line item. Now, make no mistake about this. ICRA and QSARA is geared towards employers and giving them an option to rethink their traditional group plans and honestly offer a lot more in the way of choice and honestly give themselves some semblance of long-term cost containment, whereas The increases for traditional group plans have been pretty hefty for some years now, and it doesn't seem like that trend is going away. So, one of the great things as an agent and broker is if you're able to bring a solution like ICRA to an employer and save them money, you're also going to be able to have higher persistency with those clients, meaning that they're not going to fall off the books in 4 months because the employer is contributing to their premiums. You're also going to be able to essentially give yourself a really healthy pipeline for Medicare production, because we know about 1 in 5 Americans are working past 65. So we could say roughly about 20% of the workforce is Medicare eligible. We're going to talk a little bit about how that would work in these coming slides here, but we're really believe that we're at the forefront of a revolutionary insurance solution, and it's going to open up the field to tens of millions of more prospects. So the following is not super granular, in-depth, it's more high level, and of course we're going to be developing more content as time goes on. But ICRA, you can see the phonetic pronunciation there. Shorthand for Individual Coverage Health Reimbursement Arrangement. You want to talk a little bit about that?
Yeah, it allows employers to reimburse employees on a fixed amount of money each month for health insurance premiums and healthcare related out-of-pocket expenses if they purchase their own health insurance plan. It's basically an alternative way versus traditional group plans where a company or organization can specify and budget a certain amount of money for those employees to pick their own health insurance plans, and that they can take that money and buy Affordable Care Act coverage or really what they want to do with it. The nice thing about it is, and Nolan kind of touched on it, is like your traditional group increases are usually 15 to 30% a year, and they're just passed back and forth between the carriers looking for the cheapest route. Well, when they're utilizing this kind of process, the ACA, if they're using ACA coverage, well, that's not only going to go up 2 to 3% a year. So it helps that company, really budget their health care expenses yearly and know they're not going to get a huge increase the following year. And then they're getting out of the insurance game, right? Then they're letting their employees pick what plans they want, and they'll have access to any carrier that they want rather than being tied into maybe Cigna or UHC or whatever plan that group is picking. And then as we know that, with particular prescriptions and health risks, with having more options, it can really help out the employees as well.
So, yeah, I mean, you basically have a situation where the employer is picking your options for you, and, employers of any size can offer an ICRA to any type of worker, and including part-time employees, full-time, or even independent contractors. But they're not choosing for you. You get the benefit of making your own decision as far as what plan might be beneficial to you. And it's just a matter of the employer deciding what kind of contribution they would like to make. And think of it like this: if I have a 1,200 person group policy and 200 of the people on my policy are relatively high users of medical medical services, then that's going to impact my medical loss ratio. But if I'm taking my risk pool and I'm adding essentially, going from 1,200 people to 1 million people, well, that risk is spread out a lot more. And these plans are community rated and not subject to underwriting, claims experience, or health conditions. If an employee applies for a plan, the insurance company is obligated to sell the plan at the published rate, so they're not going to rate them up based on pre-X.
Yeah, and we could really get into the weeds on this, and this is really kind of a teaser. But basically, a lot of your groups the plans are getting worse and worse, to be honest with you, where they're more in line with a bronze level plan off the Affordable Care Act without subsidies, whereas those plans on the Affordable Care Act are usually 20 to 30% cheaper than what's offered through a group option. And with the affordability rules, like this year went down from 9.5% down to 8.3% on what the employer has to coverage, are getting more expensive because of legislation.
Yeah, we're going to touch on some of that here. So an advantage of NICRA is that we just know that you're going to be able to have more predictability in the future as far as, referencing what kind of budget you're going to have into the future for your health insurance options. And the kind of the fun thing here, because we're going long on time, so we'll have to make sure we kind of sew it up here as best as we can. But if your employer's giving you, let's say, $500 a month to spend on your health insurance, and you decide to pick a $300 plan, then it leaves you $200 left over. The employer can decide, because it really puts the employer in the driver's seat as to whether or not they'll allow for that additional over the premium to be used on qualifying expenses like out-of-pocket medical, dental, vision expenses. And we talked a little bit about Medicare as well. And if somebody's on a traditional group plan and it gets collapsed to be essentially an ICHRA, then what happens with those Medicare beneficiaries, that 20% of the workforce that's working over 65? Well, those contributions from the employer can be used to pay for Part B expense or premiums. They can be used to pay for supplement and prescription drug premiums. So it's not leaving them in the lurch. In fact, it's probably moving them onto a better option than just their group health option here. These ICHRAs are also compatible with flexible spending accounts and health savings accounts. So an employer can say, let's say you have $1,200 left over from unspent contribution from the employer. The employer can decide to pull that back and save money on their budget, or they can decide whether or not they want to even let that roll over. Now, of course, if it's an HSA, then it's going to have its own requirements, as well as we know FSAs have their own requirements as well. But it's really a fascinating way that the employer can get more out of their spending, and the employee can make their choices. Now, Kisara is a little bit different. You want to walk us through a little bit about the Kisara?
Yep. So these are for smaller employees with up to 49 full-time employees who don't offer group health coverage to their employees, who can help employees pay for medical expenses through a qualified small employer, HRA, also known as QSARA. It allows a small employer to reimburse their employees tax-free for out-of-pocket medical, dental, and vision expenses, including individual health insurance premiums. Unlike traditional healthcare plans, QSARA gives employees the power to, again, choose their own insurance provider, and QSARAs are tax-deductible for the employer. So another great option for, again, small employers that maybe just aren't making enough revenue to justify a group plan yet, and gives them the option to kind of still give their employees that benefit while not burying themselves as far as costs.
Now, on to enrollment. I wanted to take this time in enrollment to discuss basically the APTCs. When it comes down to it, one of the things that makes the ACA so viable is, of course, the subsidies. Okay, so the Affordable Care Act was enacted March 2010, and it provides eligible consumers to receive financial assistance to purchase a plan on the marketplace. That financial assistance can come in the form of premium tax credits. They can also come in the form of CSRs, which would be cost share reductions for folks to lower their deductibles, co-payments, co-insurance. And, when it comes down to deciding about your PTC being used in advance, which I would say most people would like to have their premium reduced as opposed to reconciling it all during tax filing, this is basically subsidizing the premium for your plan. Now, the consumer's PTC is determined after the end of the year based on the actual household income and household size for the year at tax filing. Depending on their actual household income for the year, they may be required to repay excess APTC received when filing their federal income tax, and that can go the other way around too. So they're projecting their income, but we know things change. Now, as far as eligibility for APTC, under the ACA, consumers eligible for this advanced premium tax credit paid on their behalf if they meet all of the following requirements. Okay, so they're going to have a household income that falls between 100 and 400% of the federal poverty line. Some states have expanded Medicaid past 100% of the FPL. So, but we're going to go ahead and focus on the larger portion here, which is 100% to 400% of the federal poverty line. The American now this is an interesting piece here, and there's going to be more to come legislatively about this. But the American Rescue Plan Act of 2021 that expanded eligibility for PTC for the plan years 21 and 22, and that was actually carried over further by the Inflation Reduction Act, which extended this provision through plan year 25. And under the IRA, PTC is now also available through 2025 to consumers who are otherwise meet eligibility requirements, who have an expected household income of 400% of the federal poverty line, and I believe that caps their premiums at 8.5% of their gross income. Also, under the ACA, a consumer is eligible for APTC if they meet these additional requirements, that they will not file a married filing separately federal income tax. Now, the exception to that is maybe a special rule for certain victims of domestic abuse and spousal abandonment. So you can read further on that, but there are some interesting caveats that maybe don't come up very often, but you'll have this deck in your possession to go back and reference some of those caveats. Additionally, you cannot be claimed as a dependent by another person. For one or more months of the year, the taxpayer or another member of the taxpayer's tax family, spouse, filing jointly in dependents, is enrolled in coverage, excluding catastrophic coverage through the marketplace. Now, if you're not eligible for other minimal essential coverage, for example, and this is some of the 8.39% affordability we discussed earlier, a plan's affordability can impact your ability to enroll in an Affordable Care Act plan. So if the employer-sponsored coverage is considered affordable, that basically means that their self-only premium is no more than 8.39% of their household income in 24. That's down from, I think, 9.5% last year. If that trend continues, it's going to have some interesting implications for the market. Additionally, the minimal value of the plan that they're offered from the employer has to pay at least 60% of the total cost of medical services for standard population, and includes substantial coverage for physician and inpatient hospital services. And also, you can't necessarily be eligible for Medicaid or Medicare or Child's Health Insurance Program or TRICARE, in order to actually receive those premium tax credits. Now, what are those income limits? Well, we've got some examples here, but for most states, the 48 contiguous states and the District of Columbia, for a household size of 1, you're at 100% of the FPL. If you have an income of $15,060, and you can see that it steps on up from there. One exception to that would be that if you're a lawfully present immigrant and it is determined that you're ineligible for Medicaid due to immigration status, they must be eligible for marketplace coverage with financial assistance, even though their household income may be below 100% of FPL.
Yeah, because you'll have people that are below that $15,000 as a single person, and for some reason get denied Medicaid. So they are in fact eligible for premium tax credits in that case, even though they're below the 100% FPL.
Let's see here. So, does the consumer qualify? So when the consumer applies for marketplace coverage, the marketplace will estimate. So, we're saying all this stuff, and I think that maybe it's possible that people are getting a little bit nervous that this is going to be a lot of heavy lifting to determine what kind of premium tax credit they'll qualify for. When you use Health Sherpa, which we're really going to be steering people towards using for their enrollment platform, it does the heavy lifting for you. You have to be able to gather the information from the prospect, and you have to remind them that it has to be as accurate as possible. In my time doing ACA before, some years back, I'd have people say, well, why don't we go ahead and put in 60,000 and see what it looks like then. There are clawback limits, and you can only do what you can do on your end to verify that it's correct, but making sure that you definitely let them know that they need to be trying to make a true estimate is very important.
Yeah, and on that, so it is an estimate at the end of the day. So don't freak out. So if you underestimate their income, then they're going to have a little bit more they owe back on taxes at the end of the year. But there is that clawback limit. Which, do we have a slide on the clawback limit?
I don't have the slide back. That slide.
We can send out a sheet on the clawback limits, which will show you that it'll protect them in that case. And then if they overestimate, well, they're going to end up getting more money back during tax time too. So I mean, it goes both ways. And another thing you can do is, we kind of talked about it, but you can elect to not take the premium tax credits up front. And if they're owed them, then they will get that all back at tax time. So if they're very volatile in their estimations and it's all over the place, well, you can elect to not take the premium tax credits up front and protect them that way.
So some more items here. The forms required binder payments, the proof of income, a lot of different of these forms are required. You're going to be able to get those sent out automatically through Health Sherpa. But suffice to say that you're going to need to have the use of the IRS Form 8962, which once you get this, you'll be able to click here and it'll send that to you. But it's really not too difficult of a process. You're going to get a 1095A, or your client will. So reconciling those tax credits is a matter of, them speaking with their tax preparer, them having the proper documentation, and Health Sherpa really helps make a lot of that.
And they are mailed out to them automatically, but I'll have clients come to me and they can't locate it. Well, in Health Sherpa, it's actually attached to their account, so you can print it out in real time. And it's super simple for them.
Let's see here. We've kind of discussed some of this. If your company is offering you coverage and it's considered affordable and it covers the actuarial value of 60%, you may not qualify. We're gonna have a question about that coming up here. Now, if you want to talk a little bit about the family glitch, I thought this was kind of fascinating.
Yeah. So if they're in an employer has over 50 employees, well, you know that employee is going to have credible coverage to them because it's required by law, but that doesn't necessarily mean that the spouse or the dependents are covered in an affordable way. So they fixed what's called the family glitch this year, where basically, even though that employees offered credible coverage, well, that spouse and dependent do have the affordable tax credits available to them, where they could get a more affordable plan through the Affordable Care Act. And to give you an example, my wife works for a company down in the city. I'm not going to name them because they don't cover dependents and spouses very well. But basically, they subsidize her whole premium 100%. But then for me and my son, they didn't offer any kind of subsidies towards the premium, so we had to pay full price. Well, if I was lower income and qualified for the tax credits, we would be able to get that through the Affordable Care Act because that plan is not affordable for us as well. So there is lots of situations where you can actually glitch off those family members, and that's what they call it, to get tax credits through the Affordable Care Act as well.
So we talked about this a little bit earlier. Really any dramatic life changes or anything on this list or more, you really want to make sure that your clients know that if they have real material impacts to their lives, their household composition, their income, their offer of coverage, anything like that, they need to communicate that to the marketplace so that they can avoid any large discrepancies when reconciling what they actually received in tax credits. You'd hate for them to end up having received offer of qualifying coverage, then no longer being eligible for premium tax credits, and then they owe back all premium. And there is consequences for them not filing their taxes. Now, some exception to that is for plan year for plan years 21 and beyond. CMS is kind of taking a little bit of a laissez-faire approach to having people actually do all the reconciliation, but I suspect that will return in full force. So you always want to make sure that your client knows that they have to file their taxes. Hopefully they're filing their taxes anyway, but it used to be, and I think it will be in the future, that if you didn't file for 1 year, you could still be acceptable to receive premium tax credits, but once you hit the 2-year mark, then you would no longer be eligible for those premium tax credits.
Yeah, and if they don't file their taxes in the previous year, you'll automatically see that income verification requirement come up. because they want to verify that that information is correct for the tax credits up front too.
Cost share reductions, or CSRs.
Yeah, so CSRs are discounts that are lower than the amount a consumer has to pay for deductible co-payments and co-insurance. If a consumer qualifies based on their household income, they must enroll in a plan in a silver category to get the CSR extra savings. Typically, individuals and families with household incomes up to 250% of the FPL may be eligible to receive CSRs. There are also non-income based CSRs available to members of federally recognized tribes. And to give you an idea of what these CSRs can look like, so if they're in the 93% CSR range, well, you're going to see plans that are $0 a month, $0 deductibles, and $1,800 max out of pockets from one of the major carriers in the zip will have a plan like that. And they'll have free primary care, $10 to $25 specialist visits. So really good plans that most people don't have access to. And this is good to note because this is what separates a good ACA broker versus a bad one. Knowing that CSR is available, because the way that healthcare.gov shows you these plans, you can miss those options if you don't know they're available to them. So you'll also have a lot of brokers putting them on bronze plans in that situations with $9,000 max out of pockets where they had an $1,800 max out of pocket plan available to them, and you'll be a hero. So it's important to know what's available to your clients at the end of the day as well.
All right, we have a case scenario here. The case scenario is Robert. Now, Robert has an offer of employer-sponsored coverage. The plan covers 80% of his total allowable health care costs, and includes substantial coverage of physician and inpatient hospital services. Robert lives with his spouse, but is the sole earner in his family, and his monthly household income is $4,040, which is $48,480 per year. 8.39% of Robert's annual household income is $4,067. Robert's cost for the lowest priced plan in his employer coverage for self-only coverage is $3,600 per year. However, the cost of the lowest priced family plan his employer offers to cover Robert and his spouse is $4,735 per year, exceeding the affordability standard of 8.39% of Robert's annual household income. Robert would like to decline his offer of employer-sponsored coverage and purchase a plan for him and his family through the marketplace. Is Robert eligible for APTC if he chooses to purchase a plan in the marketplace?
So Robert is not eligible for himself, but his family members are.
Ding, 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 ding. Yeah. Yes. So, basically that employer-sponsored coverage does cover more than 60% of the total allowable costs, including substantial coverage for physician and inpatient hospital services, which meets that minimum value. However, his coverage alone is considered affordable. The family included is not considered affordable. So Robert can still decline that employee-sponsored coverage or employer-sponsored coverage and instead choose to enroll himself and his spouse in the marketplace. If he does so, the APTC may be available for his spouse because the employer-sponsored coverage family plan offered is unaffordable. But Robert would be ineligible for APTC because of the affordable self-only premium amount. So his portion of the marketplace premium would be full price. Sorry, Robert. Okay, now with that being said, we're going to start concluding here. We're going to show this video from Health Sherpa that shows an enrollment. We're going to have more trainings on this in the future. This is about 10 minutes, so feel free to watch along.
In this video, we'll walk through and show what it looks like for an agent to complete a new client's application and enrollment on Health Sherpa. Please take this video at your own pace, and we'll comment on specific parts of the application that deserve some attention. The process will begin with a search of the marketplace for an existing application. If your client has not enrolled via the marketplace in the past, no records will be found similar to this demo applicant, and you'll proceed to create a new application. You'll want to walk through the information on this privacy statement page with your client and check off these agreements. Because this is a demo, I'm skipping the Social Security number. When you're working with a client, you'll need to include this information if your client has one. For the home address, please bear in mind that some zip codes apply to multiple counties, so make sure to confirm you have the right one down on the application when working with a client. On this contact details page, we do recommend you include an email address for your client, but you can leave it blank in the event that your client does not have one. Please bear in mind that if this field is empty, your client will still receive mail from the marketplace and they won't be able to use self-service features through Health Sherpa like uploading their own documents. It's also worth noting that the contact information you provide in this section is for application purposes only. Health Sherpa will not contact your clients. In this Who's Applying section, mark Yes for the second question to see subsidies your client is eligible for. Also, add your applicant's spouse and tax dependents on this page if they have any. If they don't need health coverage, you'll just unclick the checkbox after adding their information. For this example, I'm going to add a spouse who needs coverage and make sure to save their information before proceeding. The following questions about tax information determine your client's eligibility for and amount of subsidy. If your client plans to use a premium tax credit to lower their monthly insurance payments, they'll need to file a federal income tax return for the year of coverage and answer yes to this question. In most cases, if your client has a spouse like this example, they'll need to file taxes jointly to get subsidies. The Health Sherpa application is then going to ask questions about dependents even if they don't need coverage, to make sure the application reflects the full number of household members. All right, so now we're in the applicants section. Again, we're skipping the Social Security number in this video because it's a demo, but you'll want to fill in this information if your client has one. Now, let's talk about some of the questions below. The U.S. citizen and currently incarcerated questions relate to eligibility for a marketplace plan. If your client is an American Indian or Alaska Native, mark this radio button as yes to make sure they're receiving all the benefits and protections they're eligible for through the marketplace. These final two questions ask about the applicant's race and ethnicity. These questions help track diversity and inclusion efforts and do not impact the applicant's eligibility in any way. It is required to ask these questions, but clients do not have to answer them if they don't want to. Now on to income information. When filling out this section, input the projected income for the client for the year of coverage. So if you're enrolling a client during open enrollment, put in an estimate for what the client will make in the upcoming year. For Trudy, we're inputting some income and deductible information. When filling out this section, make sure you click that Save button prior to proceeding so it sticks. This is the final stretch of the application where you can report other information that may increase your client's subsidies. These questions around existing coverage at the top are very important. You'll want to answer no to this question so long as the client will not have other coverage when the marketplace plan starts. In other words, if they're currently enrolled in a plan, but it'll end before their marketplace coverage starts, you're going to answer no to this question. You'll also notice some HRA and ICRA questions below. We're going to skip these in this demo, but please check out our walkthrough of an ICRA application after this video if you're interested in learning more. Because this demo is happening during SEP, I'm inputting a qualifying life event for these applicants. This zip code is an example of a place where you'll need to confirm the county. And that wraps up the application. If the client's ready to proceed, take a moment to review all the application answers. If something doesn't look right, hit the edit button for that section and you'll be taken right to the place where you need to fix the information. Everything looks good in this case, so let's continue and submit this app. So long as you have permission from the client, you can sign on their behalf as I am in this demo here. Once that's signed, you'll be submitting the application to the marketplace for eligibility results. You'll notice the button to enroll in coverage is grayed out. Once you view that eligibility letter, you'll be able to move on. So now that we've completed the application, we need to enroll the applicant in a plan. If the entire household wants the same plan, you can click that big blue button. In this video, we'll walk through enrolling these two applicants into different plans. So I'm going to quickly choose some plans for both of these applicants. For a more in-depth review of this shopping process, check out our quoting video after this one. Before we move on and enroll them, let's make a quick note about commissions on split policies. Only the plan chosen by the primary applicant is going to be looked at for commissions. Let's continue to the confirmation page. All right, they're enrolled. You'll notice on this confirmation page, there are some next steps for these applicants. Don't sweat writing them down. Your Health Sherpa account will make all of this accessible through your dashboard, as you can see when we click this button. So here are all their follow-ups, their application details that you can update, their plan information, their enrollment history and eligibility letter, and their marketplace notices. You can even write notes to yourself or your team if your agency is using the Health Sherpa shared book setup. And that's a wrap on the Health Sherpa application and enrollment process. If you don't have a Health Sherpa agent account, you can create one today.
That's the video there. More trainings to come, but beyond that, we have a quick little word from our sponsor, Medica IFP. This is just an example of the service areas counties, and you feel free to peruse this and
I can actually speak to that plan. Me and my son are on the Medica Bronze plan, which runs us $586 altogether with no subsidies. But they are the only bronze plan in St. Louis with free primary care and free urgent care. And they actually have $50 copay on in-network chiropractors, which I don't think any other carrier is doing that for the chiropractic. But they utilize the Mercy Network, and it's served us very well. But obviously, you want to make sure whoever you're helping's got the doctors in network, so you don't have any issues of services. But
what a testimonial! All right, and with that, we are concluding our training here. Thank you so much. Be on the lookout for more information. As noted earlier, the CMS Enterprise Portal training will black out on the 12th of July, and we suspect that it should be back up middle to late part of August. So make sure you're focused on your certifications, and thank you so much, and have a great rest of your day.
Thanks. Bye.